everyone, and thank you for watching my videos. So far, we learned about support and resistance, we learned about trend lines and channels, and we learned about Japanese candlesticks. We understand by now that learning about these can help us become successful investors. Now, we're going to learn about technical indicators. These are the tools that are provided to us in our trading platforms that can help us increase our profits on our open positions if we use them properly. In this video, we're going to learn about our first technical indicator, moving averages. Now, what is a moving average? It works like this. We have a candlestick chart, just like this right here. This candlestick chart is converted into a smooth line chart. This smooth line chart tells us where the market should be. Also, it tells us where the market should have been in the past and even gives us a direction as to where the market may be headed in the future. Now, there are two types of moving averages, simple and exponential. Both moving averages have their own unique features and benefits. Let's talk about the simple moving averages first. It works like this. We take the last closing volumes of each trading session and we divide the sum by that number that we selected. For example, if we wanted to look at a 5-period SMA, we take the closing volumes of the last 5 trading sessions. Then we add the sum. Then we divide that number by 5. That gives us the 5-period SMA. Now, if we want the 10-period SMA, what we do is we add the closing volumes of the last 10 closing volumes of each trading period, the 10 trading periods. And then we divide that number by 10. We do the same thing with the 20 and 35. I think you get the point by now. Okay, so in this chart we have 3 lines. We have a 5-period SMA, which is indicated in blue, 30-period SMA indicated in yellow, 62-period SMA indicated in pink. Notice that the 5-period SMA, the smallest number, is closer to the candles than the 30 and the 62. That's because with the 5-period SMA, we've added only the last 5 closing volumes of these candlesticks that are the last on this chart. Then we divided that number by 5. Whereas the 62-period SMA, we have to add the closing volume of the last 62 candles and divide that number by 62. So the smaller the number, the closer they are to the actual movement of the market. But the larger the number, the smoother the line is. And later on in this video, I'm going to show you the significance between each numbers. So there's different types of investors out there. There are short-term investors who open their trades in the beginning of the day and they may close their positions before they go to bed at night. There are those traders who are long-term investors. They'll open a position and keep that position open for weeks, months, or a year at an end. So different numbers gives us different types of information, and as we gain more experience in the Forex market and as we gain more experience learning about moving averages, you'll discover for yourself how to use the moving averages. So there is no specific number that we must use. Again, it's up to you and your personality and what type of trader you are. Okay, so with the simple moving average, and let's do an example of the 5-period SMA. We take the last 5 closing volumes as we can see here on this slide, we divide that number, and this is the average volume, or which tells us where the market should be. And this is really good because this gives us an idea as to where support and resistance are, because the candlesticks, they tend to gravitate towards the moving average. So by now, we do have a basic understanding as to how to use the moving average. As a matter of fact, let me go back to that chart. Notice how the candlesticks, they tend to gravitate closely to this small period SMA. We can use that when we make our trades. So when we see the candlesticks below that line, that can provide a good line of resistance for us. Or if we see the candlesticks that are above that line, that can give us a good line of support. Now, if you notice in the last few candles, they're below the 5-period SMA, but they seem to be gravitating closely towards that line. So I think by now we have a little bit more understanding as to how this can help us. However, there is one flaw with simple moving average. Let's change one of the numbers and see what type of average we get. Okay, do you see 1.3000? That number is significantly different from the other closing volumes, and that changes the average significantly. So there's a chance that we can get a false reading because the weight of each volume is the same. However, we don't know what happened on the day of the 1.3 trading volume. There could have been some special circumstances that would cause the volume to close at such a low price. So the major flaw with simple moving averages is it's too sensitive to the market. So what we need is a moving average that is not so sensitive and puts weight on the mean numbers instead of putting the same amount of weight on the absolute. And that's where exponential moving averages come in. So we can calculate the EMA with these numbers. However, there's a mathematical formula that can help us read the moving averages properly by putting more weight on the mean numbers and less weight on the absolute. And again, it's not important to memorize formulas in the Forex market. The trading platforms do all of that for us. But for our math students out there that really need a deeper understanding as to how this works, I place formulas for you. But for the rest of us, let's continue. Okay, so here, now we have a simple moving average and an exponential moving average. And they're the same period, 30-day EMA and 30-day SMA. Now, we can see quite a significant difference between the two. Remember how I explained that the simple moving averages, they're too sensitive? Notice that the blue line, which is the SMA, appears to be choppier, whereas the red line tends to be a little bit smoother. This is important because the exponential moving average reacts to the market slower than the simple moving average. So again, I'm not saying the EMA is better than the SMA. It just depends on what type of trader you are. Maybe we do want a moving average that reacts quickly to the market, depending on if we are a short-term trader, day trader, or a long-term trader. Which leads to the question, simple moving average or exponential moving average? So again, if you want a moving average that is smoother and slower and to the response of the price action, then we can go with a long period simple moving average. So if you just want to open a position and keep that position open for a long period of time and try to accumulate a large profit before we close, we want to have a smoother line. And then that smoother line we can use that as our support or resistance depending on what type of market and what type of position you're taking. Are you taking a long position or a short position? But if you're looking for quick profits during the day, then we want a shorter period SMA. And if you are looking for a moving average that does not respond so quickly, and you're not the type of person that's going to sit in front of the computer all day opening and closing positions and looking at every single chart, looking for positions that we can go long or short on during the day, all day, then the exponential moving average would probably work better for you. Okay, now how do we use moving averages to our favor? Well, here's what moving averages tell us. It tells us where the support and resistance are. So as we can see here, and towards the right, the price is moving above the moving average. So here, some of the candles are above the moving average, some candles are below. And this circle that I've highlighted here, it was testing this line of support. However, if you go towards where the blue arrow is, it jumped right below. And now the support has become the resistance. And it's jumped back up above the line. So many investors, they're going to look closely at the moving average, which is used as either a line of support or resistance. So when investors see that green candle, that bullish candle shooting up above the moving average, many investors are going to buy. Or just like this last candle, which is a bearish candle. When many investors see this action, this can indicate that many investors are going to go short. So now again, you're not the only person that's looking at the moving average. Millions of investors around the world are looking at these moving averages, and they're thinking in their minds the same thing that you're thinking. So again, that's a little bit of sentiment analysis that we can apply in our trading strategies. Here we have the moving average, and here we have the candlesticks below the moving average, which means the moving average is telling us where the line of resistance is. However, we have a green candle popping through that line of resistance. Does that mean that the bear market is now a bull market? What happens when we go long? If we don't use the moving averages properly and we don't take into consideration what happened during that specific trading session, we can get the wrong reading and we can develop the wrong strategy. So, I indicated here that it is very important to note that in an uptrend, the faster SMA will be above the slower SMA. Now, the smaller period, is faster than the larger period. So when I say small SMA, or when I say fast SMA, it means the number is small. And when I say slow SMA, that means the number is larger. Now, in an uptrend, in the bull market, the smaller number should be above the larger number. And if the market is a seller's market, then the larger number would be above the smaller number. Or the slower SMA would be above the faster SMA in a bear market. I don't want to confuse you. Now, let's talk about crossovers. crossovers are very important when we use moving averages because crossovers give us a really good indication as to where we can open a position. Now, how do we trade crossovers? Well, it works like this. Here we have a 10-period SMA and a 20-period SMA. Notice on top here we have a crossover. The faster SMA crosses under the slower SMA. Now remember, in a bull market, where is the faster SMA? Above the slower SMA. In the bear market, where's the faster SMA? The faster SMA is below the slower SMA. So, notice that we have a very important and very significant crossover here at the top, at the end of the uptrend. So here we have the uptrend and we have the downtrend. At the climax, the faster SMA falls under, and that begins the bear market. And also here we have another crossover here at the end, and a bull market, a brand new bull market just picked up. So when we see these crossovers, this can give us a really good indication that we can open a position here. So when we see the faster SMA crossing under the slower SMA, many investors are more likely to go short on that pair. And when we see the faster SMA crossing over the slower SMA, many traders are more likely to go long. So pay attention to these crossovers because this can tell you where and when to enter the market. Again, notice the two lines crossing, and notice how after they cross, the market shoots straight down in a brand new trend. And then the lines cross again, signaling the end of the bear market and that the bulls are taking over. So, here's what we need to remember. We need to remember that what some traders do is they close out their position once a new crossover has been made. So again, we can open a position, add a fresh crossover, and then we keep that position open until the next crossover. And it is more likely that we can be successful in that position and make the profit that we can make on that trade. So, how do we use support and resistance with moving averages? Well, it works like this. Here, we have a slow moving SMA. And here we have a downtrend. Now, in a downtrend, the slower SMA tends to be above the candlesticks. So, which means this line gives us some pretty good idea as to where the resistance will take place. Now, if you notice, the resistance has been tested 4 times, and they held all 4 times. So I've shown you the benefits of using fast period SMAs. Now we see the benefits of using slow period SMAs because they can give us a really good indication as to where support and resistance are. Now, remember from the previous videos, support and resistance aren't guaranteed and they're not perfect. And we cannot just think of support and resistance as lines. We must think of support and resistance as, do you remember? Zones. Exactly. See the shaded area between the 10 and 20. Guess what that is? That is our resistance zone. And notice that when the candlesticks enter that resistance zone, once, twice, 3 times, and 4 times, 5 times, it retraces from that zone until eventually here the candles crossed over that crossover point and the bear market has ended. So again, the price dropped everything when it entered the zone. And what do we do when the line breaks? So here, again, we have a 50-period SMA. And here in this downtrend, the line of resistance has been tested a few times. So in the beginning, we have resistance. However, we had a big break in this line, and the bull market has taken over. So after the break past the moving average, that line of resistance is now the line of support. So sometimes resistance can change into support, or support can change into resistance. So now we can see how moving averages can help us make our trades tremendously. Okay, so here's what we need to know about moving averages before I end this video. When we look at multiple moving averages, the faster moving average is always higher than the slower moving average in a bull market, and in the bear market, the slower one is higher than the faster one. And also, many traders around the world are looking at the same moving averages as we are. So when we make our trades, keep in mind how other traders are going to trade. And they have the same knowledge, the same basic knowledge, I should say, about moving averages as any other amateur investor. And also, smooth moving averages, they respond slower. So keep that in mind if you want to make trades during the day, or if you want to leave positions open for a long period of time. And also, moving averages can help our understanding of support and resistance more. Now, I've mentioned support and resistance many times in the previous video. Support and resistance are very important when we are making our trades, because as the candlesticks fall towards the line of support, then we can have an understanding as to whether or not the prices will bounce from that line of support. Or if the candlesticks move towards a line of resistance, we can use moving averages to give us an understanding as to whether or not the candlesticks will bounce from that line of resistance. Thank you for watching this video, and good trading.